heck are you supposed to do with a high-quality, cloud-based software as a service company in this environment where all things cloud are getting pummeled on a daily basis, no matter how well they're doing? Do you keep your powder dry, just wait for the sell-off to end? Or do you use this hideous action as a chance to slowly build up a position on the way down, even as there's no telling when the declines will stop? Hey, come on, that's the dilemma we're facing now with a terrific company like ServiceNow, NOW. For all you home gamers, that's a cloud-based firm with an easy-to-use platform that allows information technology departments at large companies to develop their own internal applications, as well as being a stock that we own from a charitable trust. Now, this may sound like a really soporific business, but the truth is ServiceNow has a total addressable market of $12 billion, because every big company needs to create its own computer programs. Plus, ServiceNow has superior technology, superior customer service, acknowledged by pretty much everybody. More important, the total cost of ownership for their software is 50% cheaper than the competition. In short, they built a better mousetrap. The problem, of course, is that the stock market currently despises super fast-growing companies like ServiceNow that are not yet profitable but trade at sky-high valuations relative to their sales. Until a few months ago, these cloud names were still market darlings. That's how ServiceNow rallied from 51 when I recommended it in October, all the way up to 70 at the beginning of March. Less than 2 months, you've given up all those gains and then some. Stocks plummeted down to $50, where it is right now. Hey, by the way, this is why I always tell you to take some profits on the way up, because who knows how long things last. Now, the company reported last night, delivering an 8-cent loss in line with Wall Street's expectations on better-than-expected revenues that rocketed 62% year-over-year. The key metric here is billings, which came in higher than anticipated, up 64% year-over-year, and up 9% from the previous quarter. Beyond that, ServiceNow also raised its guidance for the full year, yet the stock got slammed anyway, down $3.19, 6%. ServiceNow, like all cloud names, is a broken stock. But is it a broken company? Let's check in with Frank Slootman. He's the president and CEO of ServiceNow. Get a better sense of the quarter and where the company's headed. Mr. Slootman, welcome to Mad Money.
Yeah, good to be with you, Jim.
Okay, so we're trying to suss out two things here. First, how well's the company doing? And then second, I know it's my job, not yours, to try to figure out the stock. But I do need some insight. First, I want people, because it's the first time one, to understand. You said you won a client, Walmart. We all know Walmart. It would help for our people who are just being introduced to ServiceNow to say, okay, well, this is what ServiceNow does for Walmart. Can you give us some insight?
Yeah, so ServiceNow is a service management company, and service management may not mean much to the general audience, but in an enterprise IT department, it is a very well-known, very well-understood class of software. Every IT department has one. So the IT departments of Walmart and all the other companies, they have to own a system like this. And what ServiceNow has done in recent years is we've gone through a massive refresh cycle in terms of upgrading systems that have been 10, 15, 20 years old. So service management systems are essentially systems that manage issues, problems, incidents, tasks, and so on. As we all know from our experience with IT, there's always problems, there's always requests, there's always need for information, need for change. That is what our systems manage. So Walmart needs that, as does everybody else.
Well, we know that yours is dramatically cheaper than the competition, but who exactly are companies ripping out? Is it when a contract comes up? Is that when you can come in? Or can you be layered on an existing IT provider?
No, they typically replace the legacy systems from companies like HP and BMC, IBM, and CA. That's sort of the top four that we replace out there.
Okay, now, I think that, to me, until this critical moment of the last 6 weeks, when a company was spending a lot in order to be able to get great revenues, the market liked that. I'm trying to get my arms around what the market doesn't like anymore. When you talk with people today, this was a blowout quarter, frankly. It's exactly what I was looking for. Are some of the investors giving you feedback that, you know what, given the way the market is, we want you to accelerate when you can actually show a profit?
That's really not happening with our growth investors. They want us to keep doing exactly what we're doing. They're as puzzled as you are and as I am about the sentiment that's developing in the marketplace. But in the event, in the end, it will all sort itself out. And we were very clear during the IPO process 2 years ago that we were going to build a multi-billion-dollar enterprise. We were going to do it for the long haul. We would have an investment model, a growth model, and we'd be very focused on the top-line metrics, and we're going to continue to do that.
Well, that's all I can ask. One last quick question. There's a moment where you talk about going in and doing some HR stuff. Do you think people are just saying, hey, listen, all these guys are competing, Workday's now going in against ServiceNow, and these guys are all looking to go into other people's markets, and that's going to create too much competition?
Workday is actually a very good a partner of ours. We really manage the work of HR, whereas Workday managed the records of HR. So we have a very good synergistic complementary relationship. Now, the irony is that IT service models that are very well understood and known in the IT department actually are equally applicable to HR departments and facilities organizations and engineering organizations. And that's what's driven a lot of the expansion that you've seen from ServiceNow and why our revenue model has been on fire for years now.
It sure has. Well, look, I mean, the market's kind of changed its coloration. You're delivering exactly what you said you would do and then some. So thank you so much to Mr. Frank Slootman, the president and CEO of ServiceNow.
Thanks, Jim.
Okay, look, the market likes value. It just turned on revenue growth. Anyway, we're going to stick around now, and we're going to do the lightning round.